And we're welcoming a bunch of Thai students to the class. Welcome. We hope you can stay for this panel and the next one, which is going to be in the auditorium. Other than that, we're running a little bit behind, but Professor Seco, who's moderating this panel, can take it away and keep us on schedule because he is Spanish and not Cuban.
And I'm known for my speedy abilities. Okay, so we'll make it fast. So yes, my name is Seco. I came from Toronto, where we have very cold weather. So I'm very happy to be here for two reasons: the weather and, of course, the wonderful event that was put together. And I have to say that to my right, I have a very incredible, distinguished presenters who are going to start introducing themselves. But I have to give you a warning: at the end of this event, we're going to have to do a poll. Who's the good, who's the bad, who's the ugly? Because that's the title of the ESG panel. So start taking your notes, just we'll take some votes at the end of that. So maybe I would like to invite everybody to start the presentation. We'll have a sequence for presentations, but maybe we can go to the simplicity. We can go from Flavio all the way to here.
Yeah, so I'm Flavio Carrillo. I'm an associate teaching professor of finance at the Department of Finance College of Business right next door. In fact, my office is right above Starbucks, so you can wave at me every so often. I'm also the director of the Capital Markets Lab at the College of Business, and I'm also the senior director of the Truist FIU Financial Wellness Clinic. But I only get one salary for the 3 jobs.
I'm Richard Morrison. I'm Senior Fellow at the Competitive Enterprise Institute in Washington, D.C. CEI is a free-market think tank. We've been around since 1984. We do a lot of work on regulatory policy, and recently I've been doing a lot of work on finance, corporate governance, and ESG.
My name is Schanzenbach. I'm a professor of law at Northwestern University. Actually, I'm supposed to say Northwestern Pritzker School of Law, and my research is focused on finance and fiduciary investment law.
Good morning, everyone. I'm Alex Moreira. I work in sustainable finance. I spent about 20 years between commercial and development banking, and I work on climate finance strategies for financial institutions and banks, and also work with deal origination for climate positive projects. Good to be here.
And we're going to start our show here with Richard over there, who's going to give us an overview of the major SEC and DOL rulemaking some problems.
Okay, thank you. So I'm going to try and give you a summary of the state of play of ESG stuff from a regulatory and policy side, which we'll do in a fair and even-handed manner, and then give you my own at the end. The most significant ESG theme regulation we're looking at right now is the certain Securities and Exchange Commission's climate disclosure rule, which would require all public companies to submit detailed reports each year on their climate risks and greenhouse gas emissions. So the agency's initial notice of proposed rulemaking, Richardson firms are expected to disclose their own direct emissions as well as scope 2 and 3. Scope 1, 2, and 3 distinctions mentioned yesterday. So that covers indirect contributions from suppliers and calculation of the full life cycle impact of the products these companies make. The purpose of all of this is to provide more extensive and granular data to investors who may wish to calibrate their investing more specifically as to which companies have the greatest or least climate impact. Now, of course, investors obviously can make an educated guess right now that ExxonMobil has a bigger greenhouse gas profile than those software companies, but the agency has decided that more specificity is required to achieve their desired effect. The climate disclosure rule has been in process for quite a while. Some people thought it would be released several months ago, but there has also been a lot of speculation that agency observers, that the SEC chairman, Gary Gensler, may be directing the staff to make the final published rule less aggressive than the proposal in hopes of heading out potential legal challenges. We also have the Department of Labor's pension fund rule, which I'm sure Professor Schanzenbach will also address. The short story is that Trump Department of Labor, under former Secretary Gene Scalia, published a rule that clarified the investment responsibilities of pension fiduciaries, setting the standard that fund managers should only invest to maximize returns for beneficiaries and not in order to advance any other social or political goals, like ESG concerns. So this applies to pension funds that are entirely managed by professionals, and also the default options to other funds where employees are capable of directing their own retirement savings. So the Trump rule was reversed by a new Biden rule, which allows you to include funds in pension investments and as defaults in other retirement plans. More recently, however, this issue doesn't get into the news all that often. So some people may have seen last week. Congress passed a resolution of disapproval, which is something that comes out of the Congressional Review Act. It allows Congress to vote against executive rules that come out. That resolution against the Biden rule was passed with bipartisan majorities in both houses of Congress, but President Biden has announced that he will be vetoing the measure, so that will keep the current pro-ESG rule in place. Finally, we have the ESG-related update to the SEC's fund name rule. So that was originally from 2001. And it requires investment funds that reference a specific thing, a specific investment focus in their name. It's the bond fund or the Euro-focused fund or the equities fund. It requires that those funds have 80% of their holdings in whatever the thing in question is in their name. This new rule, which is sort of an amendment to that, would apply this logic to ESG funds, from things like green and sustainable, and terms like that, with the idea of fighting greenwashing investment funds trying to be more ESG compliant than maybe they really are, or to sound more ESG than they really are. So all of these, and plenty more, but the major ones are all, rulemakings are all part of President Biden's whole of government approach to climate change, and climate change pretty much always being the sort of top ESG concern. With Congress, we see a newly Republican-led House that is increasingly skeptical, if not outright hostile to most ESG policy. And we have the recent vote, like I said, but disapproving of the Biden investing rule. But there's probably a lot more coming from Representative Patrick McHenry of North Carolina, who is the new chairman of the House Financial Services Committee. He and some of the members of the committee have been pretty outspoken about their ESG skepticism. They've also formed an ESG working group, which is essentially an anti-ESG working group on the committee, and the majority has plans to do a lot of oversight hearings, including specifically on calling Chairman Gensler to talk about the climate disclosure rule. In terms of the courts in ESG, we have one big topic that's impossible to ignore, as already been mentioned several times. That's the Supreme Court's decision last year in West Virginia versus EPA. In that case, the court, the specific holding was that Congress had not granted the EPA authority under Section 111D of the Clean Air Act to implement the Clean Power Plan. But a wider point, of course, is that federal agencies in general cannot expand their policymaking into major new areas without explicit authorization from Congress. So that's the major questions doctrine. So this could have actually a pretty significant impact on ESG themed policymaking coming out of the executive branch, especially given that a lot of these policies are considered, at least by some, as new or novel, and would be viewed by courts as the kind of expansion of mission that the majority in West Virginia, the EPA, was critical of. So there are already legal challenges to other current ESG rules at the federal level, including the Department of Labor's pension rule, which is being challenged by 25 state attorneys general. On the S side of ESG, there's also a challenge from the Fifth Circuit to the board diversity rule, which was adopted by NASDAQ, but with the approval of the SEC, which requires reporting on race, ethnicity, gender, and sexual orientation of board members, and requires listed companies to have at least 2 directors in specified categories of diversity. And on the state level, there are several states that have enacted policies in recent years pushing back on ESG investing and policy trends. Texas legislature, for example, passed Senate Bill 13 back in 2021, which forbids the state as a customer from doing business with banks that have an announced policy of boycotting investment in oil and gas firms. That affects things like management of state pension funds and issuance of municipal bonds. At this point, Kentucky, West Virginia, and Oklahoma also have recently enacted similar laws. So, given all that, I think we have certain ESG sort of threats and challenges going forward. executive branch policymaking at the federal level, which is definitely where we've seen most ESG action so far, is vulnerable to skeptical appellate review, to reversal by future administration, or to new legislative reactions from Congress. President Biden's current climate policy, for example, obviously is vulnerable to policy changes from the next president, whoever that might be, just as his team reversed Trump's previous mentioned rule, but also from a possible new congressional majority. So Republicans recently retook the House, and many pollsters have noted that the Senate Democrats face a pretty challenging map going into 2024. So if we were to have a Republican trifecta sometime in the near-term future, that is House, Senate, White House, that would pretty much put an end to most current ESG policymaking at the federal level. Of course, the real reason why we're paying so much attention to executive action in the first place is that Congress has really never passed a comprehensive climate legislation in the first place. Certainly not the kind that most climate policy advocates would have wanted. So looking all the way back a quarter of a century to give the Kyoto Protocol and everything that's happened since then, large-scale climate legislation in Congress has had a pretty dismal record. So while there are definite policy risks to relying just on executive action for climate and ESG-related policy, it also doesn't look like, in the specific case of climate legislation, there's a lot more likelihood to see that than there has been at any point in the last 25 years. Now, there has been plenty of legislation, of course, that has done things like funded renewable energy, provided subsidies for electric vehicles, things that are climate related. Those are sort of carrot rather than stick policies that yesterday Prof just mentioned. But it's, in my opinion, it's unclear that we can afford to bribe 330 million taxpayers with their own money to get to net zero without having some negative effects on economic growth. One additional concern with ESG and financial markets in general is that there's a big difference between a climate activist who's willing to use finance to accomplish his activist goals and an investor who's willing to pay attention to climate risks to accomplish her profit-focused goals. So I think there's certainly some policy out there that is based on the first impulse, that is primarily an activist impulse, that is sort of tending to be the latter, a capitalist impulse. As a result, we have some market mechanisms involved in ESG policy, but that's not quite the same thing as having a true market for the things involved. So the market for electric vehicles, rooftop solar, weatherproofing, efficiency upgrades, and a lot of these other climate policies, energy policies, are heavily dependent on subsidies and incentives from government agencies, and the demand for them would likely collapse without those policies being continued. So there's a sustainability question there. The rapid implementation of a lot of such subsidy policies and policy preferences also raises up an idea that we could have a capital glut, we could have a malinvestment bubble in industries and technologies that are claiming to be green and sustainable, and underinvestment in other areas that are less technologically fashionable but still vital to society's continued prosperity. And finally, a lot of the ESG policy making we're seeing now, such as the SEC's climate disclosure rule, as mentioned in the rule, consists of bootstrapping on future predictions and assumptions, not just about climate change, but about future climate policy. So the UN affiliated organization Principles for Responsible Investment, which is one of the big players in the ESG space, likes to talk about a concept they call the IPR, the inevitable policy response. So this means that even though there isn't strict climate regulation in most places in the world right now, such laws, according to them, are inevitable. So everyone should act and plan for the future as if they already existed. Basically, the argument is, if you don't get on the train now, you're going to get run over later. But as we've seen, the kind of large-scale ESG regulation, big climate policy regulation, for example, that PRI and other advocates in this area are hoping for, are not inevitable. They're not only not inevitable, in some cases, I don't think they even appear likely in places like the United States, much less in coal-loving countries like China and India, for example. So I'll leave that there.
Thank you, Richard. And we now move to Flavio.
Thank you. Thank you so much. Very, very interesting perspectives there. And you set me up correctly here also because of performance. And investors are actually performance oriented. And they may not necessarily be activists. They may perhaps want to do well or do good, but that may not necessarily be aligned with their investment goals as well. So my area of interest actually lies in the dispersion that exists between the major raters of ESG, and more specifically, how institutional investors react to this dispersion. And so I spent quite a lot of time looking into this. I've been working on a study with the chair of the finance department at the University of Florida, Andy Naranjo, who we were actually exchanging texts at 2 in the morning concerning this presentation today and what I would actually be sharing with you. And I think you're going to find this, perhaps a little bit not what you were expecting as far as like how mutual funds are reacting, specifically ESG mutual funds, and how they actually go about their investments and what they do when changes actually do occur. So if we look at the media, there appears to be overwhelming support for ESG. If we look at some of the headlines, about 75% of institutional investors consider ESG factors as important in their decision-making process. 51% actually consider those more than in the previous year from 2020 to 2019, and 53% actually believe that ESG endeavors actually help performance and are therefore good for the investor. If we look at the literature, it's been quite well represented. CSR, corporate social responsibility, and ESG obviously is the measurement tool of it. We look at Waldman and Campbell, who worked in defining the construct itself. And then we look at others like Carrillo that actually found that many executives actually engage in CSR activities because they feel that it actually serves as a mitigator for risk. Another survey that was conducted, again, about 80% of foreign analysts, again, and these are fund managers as well, believe in the long-term effects of corporate social responsibility. So if you look at the literature, it appears to be overwhelming. So there appears to be overwhelming support for ESG engagement. Now, there's a problem, and the problem is that oftentimes the empirical evidence does not support what we hear or what we read. In a study by Borghese and Naranjo, they found a negative link between ESG endeavors and institutional ownership, and it was actually quite significant. And that is troublesome, because we're reading one thing, and yet if you look at this particular study, they're saying that, hey, greater ESG involvement actually results in lesser institutional ownership participation. And so there's an inverse relationship. What does that tell us? That institutions are perhaps looking at ESG as a premium, as a tax, rather than as an element that will actually help with the actual investments. So what we looked at is this link, and we decided to do more studies, and we found that it actually persists, not just overall, and it's actually persistent even in the individual industries. So there seems to be quite a strong support for this negative link, and so we wanted to go a little bit further into this. So one particular paper that I studied was Gibson's paper of 21, where they found a positive link between ESG rating disagreement, and again, rating disagreement means that we have the different raters, they're rating a specific company, and there's dispersion. There's non-agreement, right? So you have greater variance between the actual raters themselves, and we want to know why that's happening. And so they found that greater dispersion actually results in actually positive stock returns. And that's not necessarily good, because greater dispersion means that there's less transparency. And less transparency means that there may be a little bit of greenwashing taking place. And we all know that that's not necessarily in the best interest of those that hold these beliefs and actually are attempting to invest in these types of institutes. So we all know the major providers of ESG data. We also looked at some there was a very specific case of Tesla, 2018, 2019, where one rater was saying, oh, this, as far as the environmental pillar is concerned, they're doing extremely well, and the other one said, no, they're doing very poorly. And it's basically because raters themselves, they sometimes have differing views, they have different emphases, they have different weights within each specific pillar. So they may be measuring the same thing, but they may not necessarily be looking at the same criteria. And so therefore that creates noise. Okay? We did a study also and found that the pairwise correlations between raters for each of the three pillars seems to be quite low. And again, that's a bit problematic. So Cosantones and Serafine actually looked into what is causing these dispersions. And first of all, they found that data discrepancy is a huge one. And again, that deals again with how are we looking at the different pillars? Are we emphasizing something? Are we looking at different criteria, different points, indicators? That's a huge one. Benchmarks choices. Some of them are actually looking at broader benchmarks. Others are looking at more narrow scope. Data imputation. There's a lot of missing data in ESG. It's not like every company is going to have a history of ESG data. You may have it for one firm, but not for the other. When you do research in ESG, you realize how messy the data is at times and how much data is actually missing. So that's a problem. And then just information overload. Some companies are like, there's a lot of information on certain companies and others have very little information. So even from that standpoint, to measure these becomes a little bit difficult. So what we did, so Andy and I, we were looking at the ESG, we're looking at dispersion, and we're looking at how institutional owners react to this dispersion. So how do changes in ESG ratings for firms, right, for the individual firms, affect their fund ownership and performance. So specifically, we're looking at ESG funds. So the hypotheses, again, we're doing this in a very unbiased manner. We're looking at past literature and studies and results. So we came under the assumption that greater variance in ESG scores would result in better performance, which is not necessarily what we want to find, but that's our hypothesis based on what we have actually seen. And of course, it's based on that negative link that I shared with you earlier that exists between ESG endeavors and institutional ownership. So we went ahead and we compiled a list of ESG funds. And it's interesting you were saying, like, what is an ESG fund and if it's 80% the criteria, or how do we? So we found ourselves like stuck in this as well, because many ESG funds actually have the word ESG. Some don't have the word ESG. Others claim to be ESG, but they're really not. So we basically looked at Morningstar, and we were able to look at 226 funds that are ESG or considered to be ESG. So of those, we basically focused on open-end, large-cap equity funds. We looked at inception dates prior to January 2017. We excluded certain funds, those that actually had less than 50 million in assets, because you have funds like the Parnassus fund that it's over 20 billion, and then you have other funds that are extremely small. And we also excluded funds that had over 150 equities, because since we're trying to capture manager intent as far as like their reaction to certain changes within ESG, we felt that if we included funds that had many positions, then that would probably create noise, right? We found some funds that had over 2,000 positions, which is really more an index than anything else. You can't really manage 2,000 positions, so we excluded those large funds. So we looked at 3 providers. Of course, we will expand on this study, but we looked at 3 providers just because we had the data readily available. Robeco, Sustainalytics, and Arabesque. So Robeco and Sustainalytics are S&P and Morningstar, so they're actually quite robust. And so then, as far as the methodology, and I'll go over this quickly, we aggregated the positions of 30 selected funds. So these were the 30 funds that were selected after we went through those filters. We excluded firms that experienced stock splits, stock dividends, ticker changes, and we wanted them to be currently active. So the reason we did that is because if you're looking at manager intent and you're looking at positions and what they do to certain, or what the reactions are to ESG changes, then if a stock split occurs, then all of a sudden you have double the stock, right? You can actually throw in a denominator to reduce that, to actually go ahead and put this back in order. But there were not that many stocks within our study that actually experienced stock splits or stock dividends, so we felt like for this sakeness of actually making this better, we were going to go ahead and just exclude those. So we calculated the variance between ESG providers for each firm, okay? So basically for each particular firm, we basically we looked at the variance of those firms in an aggregate manner. We use gig sectors, and we basically use a system to assure accuracy. So I'll go over some of the major measured variables. Obviously, equity position is just the actual positions in the actual investments. Total return, self-explanatory. ESG variance is the dispersion, and ESG levels, by the way, that's going to actually be the different levels of ESG, whether they're high or low. We have a bunch of control variables that are necessary in a study of this matter, and I will just go over some of our results quickly because I know that we're running short on time. So unlike other institutional investors, what we found is that ESG fund managers do not react to changes in ratings divergence. What does that mean? Once the portfolio is set, even if dispersion among the different firms, exists or actually comes about, they don't make changes. It just stays there. So after the initial investment, they become relatively passive investors in ESG matters. Other institutional investors, however, when faced with that variance, actually reduce their positions. So it appears that they're saying, hey, this variance creates uncertainty, there's less transparency, so basically there's a risk premium associated with this, so therefore we're going to reduce our positions. But this is not what the ESG managers were doing. We also found that ESG rating levels do not influence ESG fund managers' allocations, so after the initial investments were done, they were not making changes even if these ESG levels were actually going down. And greater variance is linked to lower levels of ESG. And then finally, this is my last point, we found no link between ESG levels and total return. And so this is actually perhaps a good thing, because for institutional investors, recall, are looking at ESG as perhaps a taxation on performance. But if we find no evidence suggesting that ESG affects total return, whether good or bad, that's actually perhaps a good thing, because we can say, hey, you can do good, you can actually invest in this, and you're not going to have to pay a tax for this. So this is some of the results that we have found.
Very interesting. Thank you.
Thank you.
Max?
So I think I'll start with a broader overview of sort of this ESG world, and then I'll tie my comments hopefully back to those that have already been made. And so I actually teach trust in the states, and the question is like, why is the trust in the states guy here talking about ESG? It's because the law of fiduciary investment actually evolved out of trust law. So the law of fiduciary management, those fiduciary obligations are from trust law, and the Supreme Court has said that for ERISA funds, which are about $40 trillion, so it's like the majority of U.S. capital, is governed by ERISA. The law of trust investment basically applies, and that means you have to behave solely as a fiduciary for the interests of the beneficiary, okay? And you have to behave prudently, which basically means you have to apply some form of modern portfolio theory, which encompasses.
Sorry, just for the non-lawyers, ERISA is the law that governs pension funds.
Pension funds, yes, the Employment, Retirement, and Income Security Act of 1974, which governs your 403B or your 401K, depending on where you work. So where was I? Sorry. That's okay. Oh yeah, I was on to the duty of care. And so the duty of care is basically you have to apply some concept of modern portfolio theory, which just means you need a diversified portfolio that's matched to the risk and return characteristics of the beneficiaries. And that can be an active investing strategy, that can be a passive investing strategy. There are the duty of care provides guardrails, which is why it prompted my question for the previous panel, in which there's a zone of discretion for reasonable investors to disagree and try different approaches. One of those approaches, which I think is perfectly permissible for some of the reasons that have already been discussed, is an ESG approach. I mean, who doesn't consider or care about the environmental consequences or risks of an investment? If you're buying British Petroleum, you might want to know, are they going to have an accident in the Gulf? Do they have inadequate environmental controls? And if their environmental score is low, that might predict a future major negative event. And so, yeah, of course, if you're an active investor, who doesn't consider the environment? If you're an active investor, who doesn't consider potentially the social risks associated with a particular investment strategy, right? And so the fact that something may become illegal in the future or may draw unwanted regulatory attention makes, again, complete sense from a risk and return perspective. And then governance. I mean, this one's almost self-explanatory. If you're investing in a corporation, you might want to know who's running the thing and how constrained are they. Is there a staggered board? Is there a board comprised entirely of insiders? Are the board respectable outsiders? Of course you care about governance, okay? And so this is how ESG and this fiduciary investment world intersect, okay? But I want to draw back for a second, and then I'm going to come back to this point, because this is where it ties into what's been said previously. So the ESG conversation is taking place in a lot of different contexts. One of them is in the corporate context, that, hey, boards of directors of corporations are applying ESG. Another is the context of the securities regulations, which is, hey, people are claiming to be ESG funds, and maybe they're not really ESG funds, or maybe they're not really ESG funds because we need better disclosure rules so that some of this information can actually get to the people who are making investment decisions, and that's, of course, an area of securities regulation. And then comes the ERISA question, or the fiduciary investment question for pension funds, which is, well, given all of those rules and given these different security funds, security regulations, how do we make decisions as fiduciary investors? Okay, and so let me illustrate this with a simple example. So let's say Chevron is deciding about whether or not to invest in tar sands in Canada. Okay, and the Chevron board meets and they say, hey, they're fiduciaries, okay? And they meet and they say, hey, we don't want to do this because it has environmental consequences. Okay, now technically speaking, they're not supposed to consider the interests of third parties, right? But they don't have really strong judicial review imposed on their decision making. All they have to add is the following words, if you're in the state of Delaware. And we think it would be bad for our stockholders if we made this investment because it has environmental risks. And no court is going to review them and really think about what are the consequences, is that really the right cost-benefit decision? We have the business judgment rule, which hopefully a lot of students in the room are familiar with, where the courts basically abstain from second-guessing business decisions. And so when it comes to applying ESG factors in the boardroom, there's pretty much no guardrails, okay? Now we go to securities, and there's reasons for that. Courts are bad decision makers, and shareholders have rights of self-help. They can exit, they can vote people out, all these other things. When we get to securities regulation, now the question is, well, it's about consumer protection and information disclosure, okay? And so if an ESG fund says, hey, we're never going to invest in alcohol, I'm using this example intentionally, we're never going to invest in alcohol. Now that may be a stupid investment decision from many of our perspectives. Like literally, they won't invest in Applebee's because Applebee's serves drinks, okay? That's not really a risk-return informed decision, but it's what they said their strategy is. And so the securities law actually comes in and says, you have to follow that strategy. So this SEC appropriately fined a mutual fund, which was a non-alcohol mutual fund, because they didn't divest from Starbucks after Starbucks bought a distillery, right? They should have done that so consumers knew what they were doing. The SEC isn't thinking about, was this a good decision from a risk-return perspective? It's just, did they deliver the thing that was promised, okay? Then there's a second question about, well, what kinds of information should we force them to disclose so that investors can make better decisions about ESG factors like environmental questions and those types of things. So that's the SEC's role. And I already sort of talked a bit about the role of fiduciary law here, particularly as applied by ERISA. Okay, and this is where we actually have real standards because we have guardrails that are much narrower. You have to act for the sole interest of your beneficiaries. You can't say, according to the Supreme Court, if you're a manager of a pension fund or you're a sponsor of a 401k plan and you've constructed a menu, we're offering funds or we're recommending funds that have things beyond financial risk and return. We're avoiding oil, we're avoiding alcohol, we're avoiding some social contacts that we find appalling. that is almost the same as the managers of those pension funds dipping their hand into the till and giving that money to a charity that they like, okay? Or giving that money to a charity that a friend of theirs like, or that they think is socially useful, okay? And this is just, as a positive matter, I'm just describing this is the law. And this is why the DOL rulemaking around pension funds has been actually pretty narrow. Trump administration tried to do something really broad, which was discouraging ESG investing, and they walked it back in the final rule because they realized, you know what? There are ESG factors used in risk and return. How can we put a thumb on the scale? You know, it's going to be subject to judicial review. If we put a thumb on the scale against ESG investing just because we don't like it, okay? That is sort of we operate outside those boundaries that have been set under the statute and by the Supreme Court. If investors believe reasonably that ESG factors are useful in assessing risk and return, they ought to be able to use it just like they can use any other active investment strategy. It's reviewed the same way. Okay. But then when you get to the sole interest rule, which is you can only invest for the benefit of your beneficiaries, now if you're taking an ESG fund which says we'll never invest in alcohol, now you have a problem as a pension fund manager or an investment fiduciary. Because you're like, I'm buying a fund that on its own prospectus says, we don't consider risk and return factors for some industries, we just don't invest in them. Okay, and that puts you at significant risk as a pensions fund manager or a plan sponsor, because you've now left the world of modern portfolio theory and you've entered this world of we think there's some broader social benefit, or maybe this benefits our beneficiaries, but not directly in a financial way, which is the guardrail that the Supreme Court has laid down. Okay? And so here's the intersection that I would emphasize, because it's kind of a mess, right? We don't have a great definition of ESG, frankly. We have different regulatory agencies trying to police different fiduciary contexts, right? Corporate decision-making is really a state law matter for the most part. The securities regulations are about consumer protection and enforcing information disclosure. And the pension fund context, the fiduciary management context, is really about enforcing an actual standard of behavior that's more or less understood by investors to be modern portfolio theory and the sole interest standard. And what puzzles me, and this is what I throw out to the room, the administration is acting on the assumption that if we encourage ESG investment and if we encourage ESG disclosures, that's going to be used by pension fund managers, by these fiduciaries, in a way that's going to reduce carbon emissions or improve environmental outcomes or have better social outcomes. And that is not ipso facto, a priori true. Because imagine that Flavio comes up with a better ESG metric, and I put it into if it's reducible to a number, and I put it into a multi-factor model from finance. I can find out in that model, I'm considering an ESG factor, we can all agree on that, right? Here's an ESG index, it's how environmentally friendly are you, how good's your governance, and some combination of all of that. I put it into my model and I'm like, oh my gosh, it comes in negative. Why might it come in negative? Maybe because the Europeans are forcing their pension funds into non-carbon producing firms, and we've reduced the return on capital in those firms. Maybe it's because there's a halo effect from the industry around environmentally friendly firms, and we've actually overestimated their returns, according to my particular model. Once I get that result, I have to actually overweight carbon-intensive firms as an ERISA fiduciary, because I have established now that there is additional risk and return there. But here's the question. Have I considered ESG factors? Yeah. They just entered negatively in this particular case. And so the more ESG factors that come out, I don't think we really know what it's going to do when it's all filtered through finance and capital markets and the fiduciary standards. What is it really going to do for carbon emissions? I don't know. I could actually look at the carbon risk of firms and think, the firms that are actually, it's going to get hotter, people will use more electricity. I think the natural gas companies are going to actually do better under global warming. And then firms that are totally innocent, by the way, of increasing climate change or emitting carbons, like maybe a REIT that owns commercial property in Florida, right, is facing actual climate risk, and I should sell those firms, even though they didn't really cause, right, the climate risk. And so that's an assumption, I think, that's embedded into some of these executive orders and some of the current rulemaking that is just not at least not necessarily true. It could be true, but it is not necessarily true once the reality of the SEC disclosure rules bump up against the reality of the judicially enforced fiduciary standards under ERISA and the ambiguity about which way these factors ultimately go.
Thank you. Now, Alex.
Well, I have been left with some big shoes to fill. As you can see, it's a very interesting and complex, multifaceted discussion, the issue of ESG. To throw some more confusion into it, can someone describe or explain to me what is the difference between ESG investing, sustainable investing, or responsible investing? Anyone would like to volunteer? And impact investing, for that matter.
Responsible investing is what I do.
Okay.
ESG, which somebody else does. I mean, it's all okay.
Very good. Anyone else? Difference between responsible investing, sustainable investing, ESG investing. Why don't we throw one more in? SDG investing. Well, the answer really depends who you ask and how they define it. There is a clear line, I think, between impact investing and all the rest. Impact investing, you get the risk and return equation, and you put a third axle called impact, and then it becomes a three-dimensional exercise, especially when you talk about public equities, right? And impact investing is probably one of the hardest professions in the financial industry. I was once in a meeting with the European Investment Bank in Luxembourg, and the guy was talking to wannabe fund managers. He turns to them and says, it's not because you are going to be impact investors that I'm going to be nice to you. It's on the contrary. Let me break the news. You have chosen the most demanding profession in the world because it's really hard to actually invest, manage risk, and generate positive environmental or social impact at the same time. It's just really, really, really hard. Now, I usually describe ESG to people as a very imperfect good idea. If you ask, no matter your political orientation, if you ask people, do you prefer clean air or dirty air? Do you like plastics in the ocean? Do you like slave labor? Do you like inequality? Most people will say, no, I don't. So the objective of ESG, in my view, is to try and generate good corporate behavior. The problem is that when you talk in the aggregate about public equities, fund management, and all the financial industry in general, things get quite confusing because when you look at a rating, an ESG rating for a company, you really have to go into the underlying data, which has already been mentioned here in this panel. What do they understand by the social component of that data? And let me give you an example. British American Tobacco has been listed multiple years as one of the top-rated sustainability companies by FTSE 100. Do you know what was the fifth place in one of the years? I think 2021. Coca-Cola. Well, one might ask, are they solving any problem? No. Are they being efficient businesses by actually using less water, helping implement sustainable agriculture in the case of British American Tobacco, helping curb child labor, human rights, and so on? Yeah, they're being good corporate citizens. But the minute that you think, so it's the feel good factor for the investor. The minute that you think that a highly scoring ESG company actually does something good, you're missing the point, because they may not. And that's where impact investing really sets itself apart, because the risk-reward equation has a third axis. It becomes three-dimensional, and it's really, really, really hard to balance all of that. However, ESG investing in 2020 represented $35 trillion of assets. 2022, $42 trillion. 2025, the forecast is $43 trillion, or approximately 1/3, that's globally, 1/3 of the stock of investments in the world. ESG is here to stay. The principles for responsible investing, which were launched in 2006, so it's going to be 20 years soon, right? They have over 5,000 signatories, represent over $121 trillion in assets under management. So it's here to stay, and the efforts to curb ESG, in my opinion, are actually quite futile. It's a huge issue to politicize the ESG debate. It's just highly imperfect. Improve on it. Put in place regulations that will inform decision-making, that will inform material risks. ESG is a lot about risk management. And the definition of materiality from the Supreme Court is every bit of information that you can access that would have made the reasonable investor change their mind or consider that information in their investment decision. Take, for example, just the past 2 weeks in Brazil, in my country. It blew up in national press and international press. And the three largest winemaking companies were actually using a third party, an outsourced company, using workers in quasi-slave labor conditions. They were made work up to 15 hours a day. They were brought from faraway places. They were made to buy they were settled in remote places. They were made to buy goods from stores controlled by the people who employed them at exorbitant prices. They used pepper spray in disciplining routines. The three most important winemakers in Brazil. Now, not that wines in Brazil are anything to write home about. I, for one, I would just say, just don't bother. Or you pay really expensive for a good bottle of wine. Now, one of the wine companies had stellar sustainability credentials, and they would say, well, it's not my problem, it's the outsourced company problem. No, it's actually your problem. And for the reasonable investor, they would have wanted to know what were the labor conditions of workers in your wine country. Because the reputational risk that this company is incurring now, it's absurd. If I didn't drink Brazilian wine before, I'm not going to drink any wine until I know that they have their act together. So ESG has a purpose. It's here to stay. It tries to engender good corporate behavior, and it's part of the sustainability journey that we are all in. We can't continue doing business as usual without pricing negative externalities. Those days are over. And yes, you have to anticipate regulations. If you think that you are going to thrive by being a high carbon business, you are going to be in for a big surprise. The world is shifting away from high carbon to low carbon. So ESG has a purpose. It's just not easy. It's necessary, it's not easy, it needs guidelines, it needs regulations, it needs disclosure, effective disclosure, and all of that is being worked on. And it needs, greenwashing needs to be clamped down. The European Union has issued recently the Sustainable Finance Disclosure Regulation, and similar regulations are being implemented in the United States. They're going to come, no matter what. Now, excluding financial institutions that are friendly towards ESG, that to me is just politicized the debate. It's actually proponents of free markets wanting to go against markets, because ESG is baked in, it's here to stay. Let's just make it better. Thank you.
Thank you very much, Alex. Now it's my turn as moderator of this panel to tell you what I think. I have the privilege of being, I'm the scientist in the room, and science is an advantage, which is that we live in mental space. The law of gravity is there, independent of what judges think. We don't care, right? It could be inconstitutional, it's still there, could still kill you. So that's my approach. I'm very close to regulators. I'm very close to ESG, so don't misunderstand me. But as a scientist, as a mathematician, especially, which is my upbringing, I'm thinking. Let's talk about the future. Okay, the present is very clear. We've got an extremely thorough and impressive description of what's happening and what we should do. But let's speculate for a second. I would like you to think. You know about ChatGPT, yes? Okay, you know the kinds of things that this can do for us. So let's think about ESG. What would ChatGPT say about ESG? Okay. Well, I'll tell you what I think it would. I have no idea. I haven't tried this. Okay. But the problem that if I can summarize the problems that were mentioned here about ESG, there's something that strikes me, which is we're taking a very complex issue, ESG, and we're trying to oversimplify it because as humans we need to work with a number between 0 and 1, okay, or a rating system consisting of what 8 possible ESG ratings, right? Let's free ourselves from that. What if we could have as an ESG rating something which is just an entire database? Forget about a number. Right? Everything that was mentioned about the Brazilian company, all of that can be stored as something in a database. Look at the way stocks were traded during the Industrial Revolution. The concept of a stock has not changed very much, but the way we trade them is completely different. With accounting rules, with Bloomberg out there, we feel different about trading stocks. Although the concept of the company has not really changed very much. Could the same happen for ESG? Can we do it faster? Could we build an ESG score, which is a very large database attached to each company, and then have a ChatGPT equivalent telling you what all of those facts really mean, without the need of having everything brought down to a number and a decision which is 0, 1, yes I like it, no I don't like it. Okay. To me, I find that very attractive. And now you can start trading on blockchain and all of the data coming out of the blockchain. And this is where I spend my life. Okay. So this is my view into the future, where ESG trading would be a digital asset with a blockchain behind it, with all of the data and all the considerations there, without a human having to make up a decision as to what they are. Then, good luck in the courtroom how you resolve these things. But I leave that to the professionals. Okay, so these are my comments, my science fiction comments about this. Okay. So I think we have now a few minutes. Maybe Mario wanted to say something. Maybe the audience wanted to say something. So I would like to invite everybody.
Yeah, let me just jump in with a quick question here, which is that thank you, fantastic presentations. I've learned a lot. I think like most of the others in the room. What are a lot of the ESG framework is meant to essentially penalize carbon-intensive companies and favor the green ones. But we've seen, I always have to question whether that's actually happening, and in a particular case, whether the reverse is what's happening. And we see, I don't know whenever I see Stop Oil throwing paint on some, Rembrandt painting in Europe or whatever, to protest oil companies, I think to myself, I wonder if the oil companies aren't secretly paying those people, because everything that they're doing would result in a constriction of oil supply, which I know because I took Econ 101, is the fastest way to produce windfall profits. And then when they freak out when they see the windfall profits that they themselves have helped to cause, it's convincing, so I believe that they're doing it seriously. But I just wonder if a lot of these policies that have these noble intentions that in the application of Econ 101 you can readily see are producing exactly the opposite of what they intended to do. If that isn't somewhat attendant, and Max, you alluded to this a little bit, others as well, how are oil companies actually benefiting from ESG potentially as almost as a racket? Or what is the danger? What do we have to be careful of to make sure that they don't benefit from it?
Well, I can jump in. Any complicated system of government regulation is going to favor market incumbents that have a lot of expertise. So this is one of the things that I think is sort of the great myth of government regulation, which is the sort of political science 101 version, which is private for-profit companies being driven by profit sometimes have negative externalities, sometimes they're fraudulent, sometimes they have negative social effects. Therefore, government regulation is there to shield consumers, citizens, and taxpayers, and punish the bad, greedy corporations. That is in theory how regulation works, and in reality, often it is co-opted and captured, and new regulations are in fact approved of, pushed, and lobbied for by incumbent firms, because new firms, innovative firms, are less likely or less able to compete in a situation where all the rules and regulations are built around the current business model, which is the one dominated by the market companies. So this idea that, isn't it weird and ironic and unexpected that oil companies might actually benefit from some ESG policymaking doesn't actually strike me as surprising at all. That's almost what I would expect. Which is why some of my my colleagues and I often say, well, market competition is the best regulation, and is ironically in a lot of people's minds a less bad solution than a lot of big complicated rules, which are again often written and enforced in a way that benefits the biggest companies that already exist.
Well, it's just
No, go ahead. There's a question there.
I agree, it's totally plausible. And as you know, our companies in this carbon debate have been quite tricky to deal with, and have engaged in conspiracy, all types of conspiracies. So it is, but they know. They know very well. It's just a matter of return on capital. Hydrocarbon projects are still more profitable, and so they will keep doing while those projects. But they are outsourcing and they give externality. The social cost of carbon is not being applied to their decision making, and so regulation and carbon risk. Carbon pricing risk is part of the transition, the climate transition risks that need to be managed. And you can only accomplish that by putting the price on carbon.
That's kind of the fundamental problem, though, right? If we don't have a price on carbon, we try these second order approaches, which is let's persuade corporations not to make profits on carbon or make investments in anticipation of a possible future carbon tax. And you wouldn't have this question, Mario, if we had a carbon tax, because they would be paying it and not gaming the regulatory system or the metrics used by the SEC and so forth.
I agree, it's the most efficient way of doing it.
Yeah, and the question now, we don't have it, so what do we do?
Well, there are several proposals, just people are not willing to break it.
Great panel, especially the question on ESG versus climate versus impact. What are responsible investing? And I think that there is a lot of depends on who you ask around that. With the climate disclosure rule, though, and TCFD, the Task Force for Climate-Related Financial Disclosure, which is pushing the SEC now to adopt climate disclosure. I think Professor Layla brings up a good point. Right? How do you work with regulations versus really deep-pocketed, entrenched players that are already doing institutional entrenchment to prevent competitiveness, for example, or prevent other players from being able to enter the market? So you can, ideally, in a perfect world, free market would control that, but as you know, large players create entrenchment and pass rules that sort of solidify them and make it more difficult for free markets to participate. With the financial markets and TCFD, now the cost of capital is tied to the cost of carbon finance. So we don't have a carbon tax per se, but now you have an accounting standard as a disclosure that's saying, hey, in our profit account, carbon needs to be accounted for, which maybe gives you a clear apples to apples comparison versus responsible investing or impact investing or ESG rating or whatever it is that somebody could probably pay for versus when it's more objective to compare this apples to apples comparison. We're seeing a lot of things come down the pipeline to enable that. SEC overlooks things like MSRB, right? Which is so Miami-Dade County, for example, just met with the deputy mayor yesterday to talk exactly about this upcoming rule, which is expected to come out April 13th, next month before Earth Day. And so you have a Florida County concerned that they're going to be preempted if they meet compliance on the federal or international standard for TCFD, which is overseen by the MSRB. So we're starting to there's a little bit of conflict that's happening. Do you see some harmonization of the data for disclosure that might be facilitated through this SEC ruling that's going to be coming out? And then operationally, how does it work? Or how do you foresee groups like us here in Florida that where we have our public officials kind of concerned that they'll be preempted because of the DeSantis orchestra that's happening concerning ESG, which by the way, DeSantis, I think, is separating E from S and G in some of his own calculations, and we're sort of trying to just point towards the facts so people understand. Hey, is TCFD the highest standard for reporting? And you go for that right now, you're not going to have to worry about ESG or this other stuff because that's stuff almost incorporated there. It sort of helps streamline the process versus thinking of here's another checklist that we have to comply. Does this make sense? And it's a convoluted question, but it's a bit of policy and practice and operations, and then how we can bring it home to the relevance in Miami that we're facing given our idiosyncratic situation.
The challenge is to answer that in 3 minutes.
Yeah, I don't know exactly how it's going to interact with the local concerns in Miami, but obviously the essential point is to make a giant database of, the phrase they use is comparable, consistent, decision useful data. Although it's a little telling that they've had to adopt the phrase decision useful. I would thought that would have been obvious that you would want it to be useful for making decisions. I think that's kind of a response to some previous efforts where giant spreadsheets of data, there's lots of numbers and lots of spreadsheets, and then people have said, well, actually, this isn't useful for anything. So now we have to specifically specify, no, we want it to be useful this time. So you will have lots of data in standard format. Presumably the climate rule comes out more or less like we think it will. But the question is what, you can't assume the impact that will have, and this is exactly Max's point, that you're still going to have every individual investing, every asset manager, every retail investor, to the extent that they're paying attention to things in detail, are going to have to decide for themselves whether they care about that or not. One of my points about the SEC's goal here is that they want very detailed fine-grained data, so we know not just whether you're ExxonMobil or whether you're Microsoft in terms of how carbon intensive your operations are, but whether you are 1% less carbon intensive than ExxonMobil, or 1% more carbon intensive than Microsoft, on the assumption that there are a lot of investors and asset managers who care about those 1% and not just about big buckets of this is big carbon, this is low carbon. I don't see a lot of evidence that there's that much market demand for that granular degree of distinction between medium carbon, low carbon, sort of low carbon, sort of low carbon, and so on. So I don't know that. Obviously, all of the the investment companies and activist companies that filed comments supporting the the climate disclosure rule and said this is a good idea, we want this to happen. They said, well, investors are really going to use this data. Well, I mean, they might, but I don't think it means they're all going to move all of their portfolios in the low carbon direction because they're not in the low carbon direction now. Right? If that was your number one goal, no one would be buying ExxonMobil. No one would be buying Chevron. Everyone would be selling the things that we know are obviously carbon intensive now. So if most asset managers and investors aren't selling off the obvious stuff, why do we think there's going to be a big market change when we get down to the 1/10 to 1% differences? So, the rule's going to be very expensive. It's going to more than double the price of being a public company in terms of compliance costs, just that one rule. So it's not a trivial cost. But I also don't think there's a lot of evidence that it's going to create this giant sort of seismic shift of capital navigating against away from carbon-intensive industries, because we're already not doing that with the obvious options. But we'll see.
It's great, and Mario, we finished on time.
Yeah, I think that's amazing. The trains run on climate space, so thank you. In Canada too. Thank you let's give a hand to that great. Very, very interesting. I've got a couple of announcements real quick. Professor Ansa's students were conscripted into the class. Thank you very much. I understand that you have half an hour left in your classroom obligations or opportunities, I guess. I'd like to offer a way to complete that half an hour, which is that we're starting lunch now. In about 45 minutes, we're going to be headed into the auditorium across the way for the grand finale of the conference, which is going to be a presentation, a lecture by Brett Stevens of the New York Times, followed by a conversation between me and him on stage, and questions from some of you. For those of you who are taking advantage of the students of Professor Ansa's taking advantage of this opportunity to fulfill your classroom opportunities, I would like to offer you a free lunch in the auditorium. This is a contract. You are obligated once you start eating to go into the auditorium. Also, I'd like to clarify something else in the interest of clear investment rules. You have an unsecured interest in the food out there. The participants here have a secured interest in the food out there. So if you don't recognize someone from your class, please let them go first. Okay, so thank you very much. In 45 minutes, I'll be trying to usher people into the auditorium, so enjoy your lunches, and this has been a great conference.